question and then see. Can you define different terms of investment? What is the difference between a short term investment versus a medium term investment versus a long term investment? Who knows the duration for the investment horizon?
Short-term investment is like you invest for a few years,
maybe 1 to 5
up
years of
up
that,
up to maximum five.
and for a long term.
Guys, 1 minute. So if somebody would like to say, please raise your hand. There's an icon. So you have to raise your hand, and then Vinod will pick it up one by one, and then you can speak. Otherwise, your voice gonna overlap, and we will not be able to listen to anybody.
Thank you, Rushad. Yeah. So Vinod, you can go first. Yeah.
Okay, so according to my knowledge, the short term would be the time frame between 1 to 5 years, and the medium 5 to 10 years, and for the long term it would be more than 10 years till retirement.
Perfect. Yeah. So Neelam, would you like to add something?
Um, yes, I think yeah, the long term starts from like the minimum is 10 years and up to the age of retirement or whatever.
That's right. You guys nailed it. There is no better answer for this. Yeah, any short-term investment is the time frame between less than 5 years. The short-term investment where somebody wants to have a quick cash. I mean, like high liquid investment options are often the short-term investment options, because when the investor wants to get a decent return, but at the same time he doesn't want this to be locked up for a long time. So that is what a short-term investment refers to. The theoretical definition would be somewhere between 1 to 5 years is perfect. Yeah. And then medium-term investment is again 2 to 8 years. That's the 2 to 10 years is again the medium-term investment. And then for the long-term investment is going to be greater than 10 years. Alright, so what is the best asset class for short-term investment, medium-term investment, and the long-term investment? Anybody can answer this question? So we have different asset classes like bonds, and then stocks, and then mutual funds, and then ETF funds, golds, commodities, insurances. So these are different asset classes. So yeah, who raised their hand? Sorry, somebody was raising their hand. No one. Any answers? Any guess?
I think gold goes to the short term investment, and that stock is for the long term.
Mm-hmm. Okay, so there is no right answer, wrong answer here. So for any horizon of investments, mutual funds or the exchange trade funds are always the best option methods for investors, because it comes with a lot of advantages compared to the other asset classes. And there are the topic itself is a wide umbrella, and there are so much of different varieties of funds and details. I will just give them a glimpse what in this today's call, so that you get the fundamental understanding of what is required basically as a VMs and then to sell these products. Okay, so mutual funds are the best investment for all different time frames of best asset classes to park your money for all different time frames. The reason for that is mutual fund itself can be the fund manager can select different options based on the time horizon. All right, so I used a word called fund manager. So what is a mutual fund? So can anyone tell me what is a mutual fund or what is an exchange traded fund? Any of the definitions? Yeah. Any answers? What is a mutual fund? Come on, guys! I'm expecting some answers. You have been in the world. You're in 2024, and don't tell me you don't know what is mutual fund. It is okay if you don't know, but I expect some answers from you guys. Okay? Yeah. Somebody raising hands. Yeah. Gaurav. Yeah. Maybe could give some new entries. Yeah.
So, as per my understanding, mutual fund itself explains you that people mutually put their money, and there will be one mutual fund manager. So that fund manager, he will be having knowledge to where to invest, how to invest, and what all risk management shall be taken for uh, future occurrence, and that is something called as mutual fund. As per my understanding, I might be wrong there.
Perfect, Gaurav. That's a perfect answer, I would say. Like, that's a sharp answer, yeah. Anyone else wants to add anything to this? New hands again? Like, Sharat?
Yeah, mutual funds would be like a bundle of stocks. So it's diversified into many different technologies, healthcare, and IT sector, and everything bundled into one fund. So that will be a mutual fund.
Great, sir. Thank you. Thank you for sharing that. Yeah. So, any other answers? Anybody wants to add apart from what these two people
I think
added
so.
already?
Rajesh would like to say something.
Yeah, Rajendran?
Yeah. So when we want to understand about mutual fund, before that we need to understand the equity funds. So for example, Tesla, if you take Tesla funds, so you just invest some X amount of money in Tesla fund. So when it is goes up, so you'll get gain. When it is go down, you lose your money. So it completely depends on one single fund. But when it is like a mutual fund investment, it's like collection of funds. They will pick like a diversified industries. They will take not only Tesla, for example, Google or Tesla or a number of XYZ companies who are like well performing companies. So the fund will be invested in that one. To take care of that, one fund manager will be there. His job is to do that research and which company funds are like have a scope of it will go up or down. So based on that, the fund manager he invest the funds on that based on that company.
Thank you, Rajendra. Thank you for sharing that. Yeah. So you guys are sharp. Like most of them knows everything about mutual funds. Anyway, I would still add some value from my side. What is a mutual fund? So there are little bit of tech terms and errors which people used here and there, but so I will correct it. A mutual fund is an investment option where money from many people is pooled together to buy a variety of stocks, bonds, or other securities. It's not just about equity. It can be about bond or it can be about any other securities. Okay, so a stock or a bond is all a different form of securities and securities. Okay, let's keep it as simple as we can. So ignore the bonds and other form of asset classes. Let's stick only to the stock. Everybody knows what is a stock, right? A stock is a single stock, like what Rajendran was referring to. He was referring to fund, but ideally it is referred to stock. Okay, Tesla is a uh, is a registered company, public registered company, and then if you want to own Tesla, what if you want to be the owner of the Tesla, you can be by buying all the shares of Tesla together if you have the money to buy it. But ideally, you have super rich to do that. But so a small portion of that particular company has been divided and then given into the form of shares, and you can own a little bit of the shares so that you can own the you can be a shareholder of that company, which means you can be the owner of that company indirectly. Yeah. So that is a small example of what is an equity. Okay. So when it comes to mutual funds, there can be any number of products. As the first person said, like I think not sure the Gaurav, yeah. So it's a pool of money, and then instead of you buying and then selling a equity, or you buying and selling a different bond, or you buying and selling a different commodity or whatever securities, we hand over the money to the professionals, and the professionals does the management of buying and selling. So how do people make money in the mutual funds or for anything in the stock market world? How do people make money? It's a very easy question, dumb question. How do people make money? Yeah, Gaurav.
Yeah, so in any case, if for an example, Tesla we are talking about, so if it is having a value of 100 and if it goes up to 110, so 10 rupees is, we can say that it is an appreciation. and vice
Yeah.
versa. If it goes down to 90, then it is your depreciation, and you can also make it into profit by short selling, but it is another case.
Different. That's great. Yeah. So we will not talk about that. So how to make money? Just buy low and then sell high. Yeah. Anybody raising hand there? Yeah. Yeah. I will keep it simple. Yeah. Thank you so much. Yeah. Vinod, do you want to add something? Yeah. Go ahead.
Okay, first of all, I understand different questions. I thought the questions is different, so I raised hand. But I would like to add up something on that. So basically, when we invest on mutual funds, whatever the revenue we get is of two kind. One is the capital gain, the other is the any of the income that is distributed by the stocks or the uh, or the interest that we get on the bonds, any kind of income that is generated by those mutual funds is distributed to the shareholders. And the second thing is, if the price rises, then they will have the capital gain on it. So
that's right. That's the two way of people making money from the mutual funds. So you buy, and then every year that's going to give you a dividend income. A dividend income is like the the income generated by the company, and then they are giving it to the shareholders. So when you own a piece of share of any particular company, based on the dividend income that is provided to that company, and based on that particular amount of shares in your mutual funds or in your equity directly, that income comes to you. That's one form of income. But that's only when you buy the equities which has the dividend, which gives you the dividend income. So the most common or simple way of making money is that you invest the money, and then these mutual fund managers, they keep buying and selling based on a lot of factors, which we are not going to talk about today. Or maybe I can give you a small examples of that. And then based on the large amount of parameters, they professionally manage, they do the trading. And what do? They buy and then they sell. And when they buy, when they sell, that is not out of topic for us, okay? And based on these parameters, they do, and they make profit. How do they make profit? When they buy low and when they sell high. Say if they buy for 100 euros and they sell for 150 euros, they made a profit of 50 euros. And this is how people are making money in the market. Okay. Now, how do we get the money? We are not going to do that. We are just going to buy X and XYZ of mutual fund, and then we give the money to them. He does that, and he gives us the return in terms of every year as a percentage, and the net asset value. So that is what net asset value in simple means. That okay, you just like buying a stock for 100 and then it goes to 150, you're going to buy a mutual fund of certain units. Say like 1 unit of DWS is costing like 450 euros, and then you buy 1 unit, and then when that 1 unit, you hold that 1 unit, and that that 1 unit value goes to 500, and then if you exit at 500, that is your profit. So this is the simple transaction of how money gets transferred. Okay, and then the difference. What's the exchange traded funds? The short-term exchange traded funds refers to security that tracks a particular set of equities. So here we are not talking about different sectors. We are talking only about equities in the exchange traded funds. So with that, what I will do, I wanted to know, yeah. So what is the best form of investment? Yeah. How can you buy mutual funds? There are two ways of investing. Okay, one is if you buy on every month. Okay, like the term called SIP, systematic investment planning. So the most recommended and common way of building wealth for big people is in SIP. Okay, when you put the money in lump sum, you're attaching an emotion to that, because if you're not worrying about the invested money for the next 5 years or 10 years, then it is good. But when you put the money in lump sum, it may go up, it may go down. You put a lot of emotions to that. But when you put the money in SIP, you're accumulating every month, small amount. That will become a mountain at some point of time. With that, I have to show you a couple of videos. Let me see if I can go and present it for you guys. Yeah. Can you guys hear this as well?
No.
You just see the video?
Yeah.
Can you not hear it?
We can't hear.
Yeah.
So what happened? There's a trick when you share your screen. So I'll tell you, and then you have to do that trick. so then it's audible for everybody. So what I'm doing, do the same thing. Share, click on that, then complete a screen, and after that, there is a share audio on the top. It will come. Give control share audio layout. So share audio is blocked. You have to unblock that thing. Then audio will be shared. Can you see?
I'm not seeing that particular item, sure. I camera share and then
What I
include
said,
the
do the
this
same
one.
thing.
Got that, yeah. I hope now we should be able to see what is an SIP. Okay. Can you hear me?
You can't
Can
see
you
your screen.
You can't see the screen now?
Yeah.
No, it's not shared.
First you have to click on the share screen, and on top of that, there's a icon will come. Share audio.
Can you see the screen now?
Yeah.
Yes.
Actually, when you you are sharing the screen.
Investment plan.
Yeah.
Yeah.
In SIP, a fixed
Can you
amount
enlarge?
is invested regularly in mutual. What is SIP? SIP is a systematic investment plan. In SIP, a fixed amount is invested regularly in mutual fund schemes. These schemes have the potential to beat inflation and create wealth in the long run. For example, if Rahul invests 5,000 rupees per month, his total investment for the year is rupees 60,000. Assuming the rate of return to be 12% per annum. Thus, 12% of rupees 60,000 is rupees 7,200. Then, at the end of year 1, Rahul can create a wealth of rupees 67,200. Even with market highs and lows, Rahul invests the same amount of money at each stage. And the ultimate result is steady rise in returns. The advantage of SIP is there is no need to time the market. Thus, in an SIP, fixed amount is invested in the fund of your choice from your bank account. And you can stop the SIP whenever you want, and there are no penalty or additional charges levied. In the long run, SIP investments can help you fulfill the big dreams of your life by starting small. Interested to know more? Keep watching. Share.
Okay, so that is a very clear, simple, perfect explanation for an SIP. Okay. Now let me go and then present the next one. Come on. Thought I pasted it as a link. Never mind.
A mutual fund is a collective investment that pools together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can potentially benefit investors in several ways. They can provide diversification. Most are managed by financial professionals, and they offer investors a wide variety of investment types. To see these benefits in action, let's walk through an example of how a mutual fund works. Suppose there's an investor who wants to invest some of their retirement portfolio in the stock market, but they don't have time to analyze individual stocks and create a diversified stock portfolio. Instead, they decide that they'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for them? To find the right one, the investor uses online tools, such as mutual fund searches and ratings given by independent third-party organizations, to find a mutual fund that meets their investing goals. Once they find a fund that looks like a good fit, they review the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides useful information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and more. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So they buy the minimum required investment amount and purchase shares of the mutual fund. By owning shares, the investor now participates in the gains and losses of all companies held in the fund. A benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this can help lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small, because that struggling company is only one fraction of the fund's total assets. Another potential benefit is professional management. Like many other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Fund managers aim to provide the biggest returns they can for investors by using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns they were hoping for. However, if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only costs our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. Now that the investor has bought into a fund, how might they make money from it? One way is through appreciation, which is when the fund's shares go up in value. Typically, when the fund's assets rise in value, the fund's shares do the same. However, when the fund's assets fall in value, the fund's shares do the same, which is a risk of owning a mutual fund. Unlike a stock, the value of a fund's shares does not change throughout the trading day. Instead, the fund's value is calculated and updated when the market closes. Another way an investor might make money through a mutual fund is from a dividend payment, which is when a mutual fund pays out a portion of its earnings to shareholders. Finally, another benefit of mutual funds is the variety of investments they make available. Our investor chose a mutual fund that invested in stocks. However, there's a mutual fund for almost every type of investment. For example, equity funds buy stocks, fixed income funds buy bonds, and balanced funds buy both. Some mutual funds may invest in a whole index, while others focus on stocks of a certain country or market sector. Certain funds have different objectives as well. Some may look for riskier stocks in growing industries, while others will invest in more stable companies. There's a lot to learn about mutual funds and other investments, and we've got the resources to help you get started. Take a look at more of our
All right, guys. How many of you are sleeping? And then how many of you are actively listening to that? So that makes everybody a pro in the mutual funds, isn't it? So did you guys understand the fundamental concept of what is a mutual fund or what is a fund and how it is managed?
Yeah, that's good.
So I'm pretty sure the people who are switched off their cameras are probably not in their desk. All right, guys. So that is something very, very important that we have learned so far. So now, what other things we have to know is what are benefits of purchasing a mutual fund? I think the video explained the rest of the part, like what are the benefits and why it is important. Okay, so now what is an equity fund? What is the difference
move back
between
to the older slides. Sorry, Vinod. Can you go to older slides? More older slides? No, next. Okay. So I have a few questions. I think a lot of people, those who have switched off the camera, so question to them. Okay. Question number one, we talk about the investments. Investment, whether it's a fixed deposit, insurances you have studied, mutual funds, equity. So first question, if somebody is investing in the equity, mutual fund also invest in the equity, right? Just now Vinod said. So if somebody has invested the money in the equity, can it be zero? Your investment, can it be zero? So question two, let me see who is switch off the camera. Yeah, give me a moment. So maybe everybody switch on the camera. Okay, so who will tell me? Maybe you can raise the hand. I don't want to pick it up. Okay, so you can raise a hand. My question is, can the equity investment could be a zero? Zero. You have invested some money and it will become zero. Gideon has raised the hand first. Yeah, Gideon.
No, the investment doesn't become zero because it's based on market condition.
Okay, very good. Thank you. Rishi, can the equity investments could be a zero? Can it be a zero?
No, again, my answer is same in that equity investment can be zero because it entirely depends upon the real value of the share.
Sure, thank you. Rajesh, can the equity investments, listen my question carefully, can the direct equity investment could be a zero?
Can it become a zero?
Yeah, sure. When we directly put our money in the stock equity fund, that there is a chance.
Anybody else?
Lot of company comes and goes, so their fund everything is gone.
Anybody else? Who will tell? Anybody? The direct equity investment, can it become zero?
Yeah, there is a possibility. Yeah, there is a possibility of becoming zero.
The answer is yes. If somebody will invest in the direct equity, if tomorrow that company will become a bankrupt, it can be delisted. It can be, that's a lot many things can happen. You remember earlier it was a Kodak, very famous company. Now no one knows the Kodak, and then everybody is just having this mobile phone. They are taking the number of pictures. It becomes a history. Likewise, a lot of companies, they have come. I'm sure 10 or 15 years ago you were using those products, but now those products doesn't exist. And I don't remember, that's a one company was there during the Corona time. That's in Europe, one of the biggest European company, and that's 2 billion euros. It was vanished from the balance sheet. 200 billion euros. So, and that's got bankrupt. I don't remember. Maybe I'll put it on the chat box. One of the biggest European company as well. It got caught in the audit over the night, and till date, no one knows where the money has gone. So, direct equity investment, it can be become zero. Okay. Now, question 2. Can the mutual fund will become zero? Can it be zero? Mutual fund. You invested in the mutual funds. Can it be zero? Yeah, Rajesh.
No, it will not be zero.
Okay. Vinod.
Yes.
That's me, Vinod, I think, yeah.
Vinod,
yeah.
Okay. Yes. Yeah. The investment in a mutual fund, it's a very weird. It's a very weird that it might get zero because there are. It's the mutual fund means a portfolio of the investment. Means there is other investment that will substantiate the loss. The other investment is the.
Answer is yes or no. Can it be zero?
No.
Rishi, mutual fund investment, can it become zero?
It it can become zero on a situation when all the funds you have invested, all the funds that fund manager is holding become zero bankrupt. In that
So practically, again, answer is can it become zero?
Yes.
Okay. Priyanka,
No, according to me, no, because it was diversified to the different companies.
anybody else? Any other answer? Sharat, what do you think? Mutual fund, can it be zero? Sharat.
Yeah, there are two possibilities. If you are investing in direct mutual fund, no. If you are
Mutual fund
investing
is a mutual fund. What is a direct indirect?
direct, it's like there are no broker or any other charges are there. It's like that. Yeah.
Okay. So you mean to say if somebody is investing in direct mutual fund, then it can't be zero. If you are not investing through the direct mutual fund, then it can be zero.
It depends on the company. Yes.
Neelam, what do you say? Can it be zero?
I think no.
Okay. Anybody else? Pushplata, can it be zero?
Yes, it can be volatile.
You are talking like politician. Don't be a politician. You have to say yes or no. Can it be zero or not?
Yes, yes.
Okay. I think somebody else has raised their hand in between. Wait 1 minute. Let me find. Who has raised? Yeah, Roshita.
It can be it can go to zero.
Yeah.
So what? So this is my first class, and I'm not really very good at finance.
I'm also
I have zero.
good in finance.
No, I have zero knowledge about it. So according
What
to
your common sense is? Common sense.
yeah, so according to what I understood from today's class, I feel it can go to zero if all of the stocks fall together at once. Then it can go to zero. That's what I understood.
So, who is from the science background? So, if you study the chemistry of physics, so in the chemistry there is a ideal gases, and another one is a real gases. So, ideal gases you aim, and then real gases try to achieve that condition. But ideal gases usually doesn't exist. Okay. So, likewise, or noble gases doesn't exist. Okay, it's a ideal situation altogether. So likewise, mutual fund, theoretically, if you say, it can become zero, but that's not possible. Okay, I'm contradicting my words because fund manager, who is a professional fund manager, he used the formula of the diversification, golden rule. Put all your ball in the different basket, not in one basket. So what is the probability? So suppose I'll give you a very simple example. I'll share my screen and then give you simple example, and it will give you a little bit idea. Why I'm giving you the idea? Because guys, a lot of people, they are joining first time. That option should be clear in the mind, because a lot of people, customers, they'll bombard the question and they'll doubt. So first you have to convince yourself. So there is a one mutual fund which is very popular, and name is DWS US Pro. So it's from the Deutsche Bank Investment Banking Division, which invest in the US growth market. And total fund value of this fund, 1,095 million euros. When we see where they have invested in the Microsoft, Alphabet, Apple, Amazon, Meta, that means Facebook, and so on. So people can directly buy the Microsoft as well. People can directly buy the Alphabet as well, Apple as well, Amazon as well, Meta as well, and Sonstic as well. So if you buy Microsoft, is there a possibility Microsoft will go go bankrupt down the line 10 years? Of course. It can go bankrupt, right? Over the night. Something will happen. Or what is the chances that all the companies. So let me just change the question. Is there any possibility that Google will go bankrupt? Is there any possibility?
Yeah, there is a
Is there any possibility Google will go bankrupt in 5 years?
maybe.
Is there any possibility Apple game would be over and then in 5 years it go bankrupt? Maybe. Or maybe is there a possibility that's Amazon? So Amazon was the biggest billionaire. Now Elon Musk has took over, right? So is there any possibility that Amazon will go bankrupt one day? Possibility.
Yeah, there is it. Yeah.
Good chance. It's a life uncertainty. Now there's a chance, but how much percentage chances are there that Microsoft, Alphabet, Apple, Amazon, and Meta they will go bankrupt same day, same hour, same time? What is the probability? All these
1%.
5 companies, same day, same minute, same time, will go bankrupt. What is the probability? Is there any possibility that all the companies, Google, Apple, Microsoft, Amazon, and Meta, Adobe, same day, they will go bankrupt? Everybody will declare the bankruptcy, collapse. What is the chances? How much percentage chances? Answer, guys.
Less than 1%.
Anybody
1
else?
or 2%?
1 or 2%?
No, 0 point something percent. Different percent.
Anybody else? 5 big companies. What I am saying, when you talk about the alone,
Sir, I would
Could be
like to say it's unlikely, but there should be something revolutionized so that these companies all get bankrupt.
think about my question. I think you didn't understood. Listen carefully. When you wanted to win the Kaun Banega Karodpati, then you have to listen carefully. That's a judge